Now, you and I had a conversation before the program about what's happening around the different states. You've been traveling
Yes, yes,
recently.
yes,
I think
yes,
last week we spoke to you as you were getting off a plane.
yes.
Can you give our listeners a bit of a rundown as to what's happening, perhaps maybe in the Darwin market, the Northern Queensland market, maybe the Perth market, the markets that have been impacted by mining?
Well, look, there's no doubt, Peter, that those markets, as you said, that have been impacted by the downturn in the mining industry, their housing markets are also, I guess, reflecting that lack of economic drive. I was in Darwin last week. Their median house prices are down at 4-year lows at the moment. But that Darwin market was a very strong market. A lot of what was driving prices there was outside forces, the fly-in, fly-outs. And look, the Darwin market, its median was at one stage as high as the Sydney's median 4 years ago. So I guess there's an adjustment process there. Market will start to bottom out once those perceptions that, it's a good time to buy, prices are as low as they've been for a while, and of course with the low interest rates. Similar circumstances in central and north Queensland.
Yep.
Same driving influences, the end of the mining boom, the end of the fly-in, fly-outs. People are now travelling into Melbourne and Sydney looking for work. It's almost a complete turnaround from that drive into mining that really created those very strong markets in recent years.
What about Western Australia and Perth?
Well, look, probably Perth is the market that still has the longest journey to get back to the bottom of its cycle. The Darwin market has low unemployment to keep driving it, so confidence there can return because there's no issues to do with concerns over job security. But the unemployment rate in Perth, just released last week, is now up at 6.6%.
Wow, that's
and
getting
that's
pretty
the
bad.
highest in a long,
Wow.
long time. And that, of course, will keep buyers and sellers on the sideline because they're obviously concerned about job security, and this is what we see exacerbating, I guess, the sort of the downturn in the cycle. So, look, a longer journey in the Perth market. Prices, again, similar to Darwin, are at 4-year lows, but it would really need to start to see a turnaround in its unemployment rate, particularly, or certainly its jobs market, to find the floor in that in what is still a downturn in the market.
I think it's really interesting because you do have an economics background and you do look at things holistically, and at times people talk about how expensive Sydney is or
Yes.
how expensive Melbourne is, but they really are where they are for a good reason.
Well,
right?
absolutely. And look, we're very fortunate in this country in terms of what keeps our markets in balance. And we can talk about markets that are, I guess, in downturns at the moment. But in reality, we're restricted in terms of our lending environment. And it's the banks, and, we love them, we hate them, who knows. But it's the banks that keep those boundaries around our lending that stops us from taking the risks, particularly in a hot market, that pushes prices beyond their sustainable levels. And, banks really won't lend you more than 80% of their value.
Yep.
They won't let you repay more than 25% of your income for your mortgage. And these are the things that keep the balance in our market. And it's because the reason this happens is because banks have so much market power. They don't need to take risks. They'll still make extraordinary profits. So, look, it's a positive in terms of how it keeps our housing markets in balance.
What about those lending institutions that have no doc home loans and they do lend 110, 120% of a property? Are there any of those left?
Look, I don't think so. And look, those are certainly marginal. And at the end of the day, the offset for taking higher LVRs of lending is mortgage insurance. So it's passed on. The risk is passed from the lender to the mortgage insurer. Now, you pay a higher premium for that, and that's the cost. And they will also have stricter lending conditions in terms of those that want to take a higher LVR or to have a higher repayment threshold for their mortgage.
So for an investor listening to the program, driving home from work, thinking about where to move next, where are some pockets that you find look not only strong, because strong markets are expensive, but maybe a little bit of value also?
Well, it's chicken and egg. Strong markets are expensive, and therefore they attract more
Yep.
investors. Now we're going to get some prices data released over the next few weeks regarding the September quarter.
Yep.
And it will show that the Sydney market is certainly up and running again in terms of prices growth. Now, one of the significant drivers of the Sydney market, not just at the moment, but over the cycle, have been investors.
Yes.
Now, investors are making up nearly 60% of lending into the Sydney market now. It was as high as 65% a year ago at the peak of the boom. Now, once we see that prices growth being revealed again in Sydney, you will start to see even more investors into the marketplace. And now it's not so much about, I guess, the entry level in terms of not being able to afford to buy a house in Sydney. It's about taking advantage of the capital growth that most investors have had in other properties. But of course, there are better opportunities in terms of lower entry points. But look, and that means regional centres, smaller markets, perhaps Adelaide or Hobart, which certainly offer the same sort of returns incrementally, but don't have the same, I guess, drive for prices growth that Sydney market has. You just can't keep the Sydney market down at the moment. It's
Very
always
strong.
looking to have prices increase, and a lot of that is because of investors.
We're talking property. Peter Esho is with us. Dr. Andrew Wilson, senior economist with the Domain Group. If you were going to buy an investment property anywhere in Australia, where would you go?
Myself?
Yeah.
Well, look, I think most investors like to stick with their local neighbourhoods. It's certainly their local capital city. Investment is more and more now about the longer journey. It's about yield. It's about sustaining an investment vehicle, perhaps to supplement your superannuation. So it's less and less about looking for that hot spot where prices are going to, rise quickly, that maybe there's a trough in the market. And I think that's the positivity of residential investment and why we will see more residential investment now, I think, than ever before, because it's in a low growth, low yield, low interest rate environment. Residential property returns are going to maintain the highest returns, particularly given those significant tax advantages that residential property has. And I mean, there's a bit of, it's only 3% or 4% gross returns in Sydney. But, what do you get with your interest rates? And,
Not only
and
that,
the tax advantages
if you
are
compound
still
it,
profound. That's right.
if you compound that, what I tell people is if you compound 7.2% every year, in 10 years you've doubled your money. So, don't just think about the return today, but if you give yourself enough time and it's compounding consistently, that's how you build the wealth.
Well, absolutely. And as I said, I think that we will see more residential investment demand through the cycles now in all capital city markets, and it will become more of a localised activity rather than looking for the hot spots perhaps interstate or in a regional area.